Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, here we are, Jim. A rainy, gloomy Friday in Vancouver, but the markets have a fairly bright tone to them.
And for people who know the West Coast this time of year, we had a week of sunshine, so we shouldn't complain that the rain was delayed for a week, because now we'll probably have solid rain until May.
Okay.
Now, our listener question today comes from Eugene E. Hoffman. He sent this in late September. We didn't have time to get to it the particular week that he sent it in, but I think the question is still valid now. Eugene writes, Brandon Woods in 1961, the U.S. added 100 tons of gold to the London gold pool. That was worth $135 million in 1961 gold prices. Obviously, that wasn't enough because the gold pool collapsed in 1968. In today's dollar value, with gold around $2,000, that would be $7.7 trillion. Ask Bob, if the U.S. printed $70 trillion, would that be enough to keep the U.S. functioning for the next 10 years?
Boy, what a good question. The so-called gold pool fell apart because the U.S. And other countries were advised by interventionist economists, and the only one thing they know, and that's push out credit, because they think it pushes the economy, which it doesn't. So, anyways, the number of dollars floating around was growing, and they wanted to keep the gold fixed at $35, and they couldn't. And then it all fell apart. Actually, it was in August of 1971 when Nixon finally faced it and said they'd close the gold window. So, but then to say that much gold then is now worth so many trillions, yeah, that's an arithmetic thing. But if the U.S. were to print $70 trillion now, would it be enough to keep the U.S. functioning for the next 10 years? No. The last three bubbles, like 1929, it's not widely reported that the Fed bought huge amounts of bonds out of the market, injecting cash into the economy, and such that even in as late as July 1932, which actually turned out to be the bottom, the highly regarded Barron's magazine editorialized that every anti-deflationary measure taken by the Federal Reserve System is seen not to work. And that was buying bonds out of the market. Now also, in the 1873 bubble, the U.S. did not have a central bank. But at that time, a leading newspaper in New York editorialized that nothing could go wrong because the U.S. did not have a central bank on a gold standard. And so then there was freedom by the Treasury to buy any number of bonds out of the market, and they did buy bonds out of the market. And eventually that contraction that began when the bubble failed in 1873, it became known as the Great Depression, and it lasted to 1895. And then also I've got a lovely quote from right at the bottom of the panic in the 1825 crash, where the Bank of England met the requirement, the need for liquidity by every measure they could, just huge amounts of money going out. But the thing is that once you've had a full and classic financial bubble and it fails, you go into a lengthy post-bubble contraction, which I think is ahead of us. And thanks very much for the question. It sure brought out some old dates.
Bob, my question is, we're hearing noises, the Bank of Canada and the U.S. Fed saying, well, if these 0 and 0.25 interest rates aren't giving us a kickstart, why don't we try negative interest rates? And my reaction is, well, if negative interest rates work, Europe and Japan would be booming, and they are not. Is that your point of view as well?
Oh, that's a great point. Now, the other way to look at it, Jim, is when you take the nominal rate of interest, which is the one you look at in quotes every day, and then adjust it by the rate of inflation, and then that gives you real interest rates. And the history on a bubble is that real interest rates declined during the boom, and in 3 out of 5 of the previous bubbles, it went to minus real terms. I think one of them was minus 5%. So I think it's an important way to look at it is through the real rates, interest rates, through adjusted by inflation. So real rates now are still low, but it looks like the long Treasury rates in the U.S. are trying to turn up. And I think with a little concern in the financial markets, you'll find that many low-grade corporate bonds will turn up in yield. So, I think the question about the U.S. deliberately putting rates to minus, aggressive traders have been playing this one for more than a decade, who look at the German rates going down to less than 0, and at the top of each bubble or a strong rally in the bond market in the U.S., that has been dragged out. But no, I don't think the U.S. nominal rates will go to 0, and even as low as the real rates are now, it's part of the bubble and eligible for change.
Also, Bob, wouldn't negative interest rates be a financial disaster for pension funds, banks, and insurance companies?
Oh, absolutely. Absolutely. Even these artificially low rates are a disaster for them. In previous times when you've been in a post-bubble decline, interest rates sort themselves out and you get paid for your risk and people go about it, but the distortions put in by very aggressive central bankers, they just make the bubble part bigger, and the bigger the bubble, the harder the crash. So the influence of central banking, let's call it intrusive central banking, objective has been to smooth out the business cycle. And actually, as the Fed was being formed in the 19-teens, the powers that be then fully understood that when you had a financial crisis, it was followed by a recession. So then that's where they came up with the concept of the Federal Reserve being the lender of last resort, which would bail out a financial agency or bank that was in trouble, and that would prevent the crisis. And with no crisis, you'd have no recessions. That's the theory. And, Jim, I got to tell you, it is a very appealing theory that they can prevent recessions. But it's just let's not even call it a theory, it's a hypothesis.
Bob, are we not in the 19th recession since the U.S. Fed was invented?
Jim, this is number 19 on the recessions, and the theory behind the Fed is that they could prevent recessions. What a lot of nonsense. Anyways.
And Bob, this, I guess, would confirm Einstein's theory on insanity. He said insanity is doing the same thing over and over again, expecting different results.
Oh, yeah, I like that one. Yep, they do the same old thing, and you can go all the way back to Roman times, and there was a book published in 1938 called The New Deal in Old Rome, and it was the same thing. Under deflationary pressures, the government formed an agency to provide interest rates to farmers at below market rates of interest, and if there was too much wine around, they would then pay the vintners to tear out grapevines. And so in Roman times, over a long period of time, the bureaucracy did exactly the same thing as what they did in the 1930s when Roosevelt called it the New Deal. And the folly continues century after century that governments can only respond to things, and we'll see what they'll be doing on the next leg down in this stock market. So
we'll have more with Bob Hoye when we return.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, one of the headlines that caught your attention, in some parts of the country, house buying is like a drunken land rush, with home sales up 40 to 50% compared to the same time last year. What's going on?
Well, it's a big shift. I guess people are leaving downtown parts. Like, would you want to be in downtown Portland or even in Midtown Manhattan? It's turned into a disaster and people are leaving. So then in outer regions, you've suddenly got this unusual demand for housing. So and this is house sales. These are not house prices. So the percent gains in house sales in the U.S. are the largest since 2006 and 2007, which was when that incredible housing bubble blew out. And some consider that the fallout from the housing bubble really did caused a lot of harm to the financial markets, and I can agree with that. We had a couple of good charts on that one at the time, and wrote a couple of pieces on the end of that housing bubble and compared it to the end of the residential real estate bubble in Florida in 1926, I think it was. Yeah, it preceded the top of the stock market in 29, but in 2007, that ultimate peak in the crazy residential market was pretty close to what the stock market year. So what we want to look at, Jim, is the excesses, big excesses going on in house sales.
Bob, also, what about record low mortgage rates? Is that also a driver, especially in the U.S. where you lock in for 30 years?
Yeah. No, it's I think it helps that you've got record low mortgage rates or let's put it this way, attractively low mortgage rates, and you got attractively low rates on buying cars on the Never. So, yeah, but all these low rates have been on for so long, it's now part of the built-in, and somewhere the financial markets are going to get an incredible shock when prices and yields go back to reflecting what the real risks are out there. And Mother Nature, through the financial markets, really can do a very good job at keeping things real. And she also has been very good at correcting things when it goes unreal. So I think there's still some risk here before year end in the financial markets.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, another headline that caught your attention. In 2020, state and local governments in the U.S. will lose between $100 billion in income to $250 billion from lost taxes and sales taxes. If you extrapolate that to Canada with a population that's 10 times smaller, that's still, 10 to 25 billion lost in local and provincial taxes. What's the long-term fallout from that, and does that automatically translate into bigger tax hikes in the future?
No, they might run into resistance. People leaving major core cities. Oh man, that's really something. They're voting with their feet, but then where they may not be leaving the central cores of cities, they may get and put their back up and say, no, you have to adjust. Government has to adjust its lavish style down to what me as citizen can afford. And this is the problem here, is that governments at every level and in most countries have been crazy in expanding and perks and all that sort of stuff. And in the case of the U.S. with their cities and some counties, is that when you retire, these guys are going out and retiring with pension benefits that are greater annually than the average income of the average taxpayer. So it's a huge distortion. And then this is being made worse over the last while with bond yields so low, because with pension funds, you've got actuaries there, and they can sit down and calculate what the outgo is going to be, and then normally there's enough return from the fixed income side, because for life insurers and pension funds and things like this, it's best to have it backed by a flow of cash from the fixed income side. But then this has been all distorted. So there are some artificial things out there that are throughout history have been unsupportable when they get pushed this far. And part of the problem will be as they say in America, the state and local level of government. And in Canada, that translates to the federal, provincial, and municipal level of government, where the extravagance of these governments and their administrators and their government employees, they've been getting better deal than the taxpayers have. So I can see a natural contraction in the credit markets working the system over. But I can also see the ordinary folks looking at their hardships when the governing classes are living well, and this is then the recipe for a benign popular uprising. And the last successful one was in Eastern Europe, when local ordinary folk took on a murderous communist police state, and the symbol of it all was it was November the 9th, 1989, when they took down the Berlin Wall. Absolutely astounding. And the ordinary folks then took on an armed and murderous police state. And it's worth pointing out, in the United States, a whole lot of ordinary folk are well armed, and the government, particularly where it's Democrats, are extremely authoritarian. I think that when it comes to the showdown, that the Democrats are not going to turn murderous in the face of an armed ordinary folk, whereas in Eastern Europe, the state with its arms did not act, and the folks unarmed did act, and as I say, the gesture was taking down the Berlin Wall. That was so exciting, I couldn't believe it. It was wonderful.
Yeah, and that all started
I think
with
the equivalent is needed, where the Obama administration and its continuation in the Democrat Party have been building the equivalent of the Berlin Wall in the regulatory and legislative sense, massive intrusion, and the popular uprising will be engaged in tearing down the legislative equivalent of the Berlin Wall. I hope I'm around for it when it comes. It's going to be most exciting.
Yes, and of course it all started with the Solidarity movement in Poland, in Gdansk, led by Lech Walesa. So
that was ordinary folk. Yeah, I just concentrated on the East German side with the wall. It was the only time in all of mankind's history where you build a wall to keep the people in. Hitherto, all walls, whether it was Hadrian Wall across England or city walls, they were to keep the bad guys out. But it's the only time in history where they build a wall to keep people in. Isn't that amazing?
Bob, thank you so much for chatting with us.
Well, we've had a bit of Friday fun today, and look forward to next week, Jim.
And a happy Thanksgiving to all of our Canadian friends, and a happy Columbus Day to our American listeners.
For sure.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob and he loves to answer them, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.